Good morning. Here is the one thing worth carrying into today. Nvidia reports tomorrow after the close, and it arrives on a 7-day losing streak, the longest since 2022. That is being universally explained as nerves before a big print, but zoom out from the week to the year and a much stranger picture appears. Nvidia is up roughly 12% in 2026. The Philadelphia Semiconductor Index, of which Nvidia is the largest single member, is up roughly 61%. The market is not doubting artificial intelligence. It is buying artificial intelligence about 5 times more enthusiastically through everyone else than through the company at the center of it. That gap is today's brief, and it runs underneath almost everything else on the board. The S&P 500 sits at 7,652, the Nasdaq at 25,980, and both closed lower, dragged by the chip complex. The Dow went the other way, at 53,417, which is the shape of a rotation out of technology and into everything else rather than a broad risk-off day. One caveat I want to be straight about. The published percentage moves for that session do not reconcile with the point moves in the same reports, so I am giving you levels and direction, and I am not going to assert the size of the move. On the bond side, the 10-year eased to 4.701%. Gold is around $4,637 an ounce, holding near a 3-month high, and the driver there is a softer dollar rather than anything new in the metal itself. West Texas crude is near $83, and it is lower, which is worth pausing on because it fell into an announcement of expanded sanctions on Iran. And Bitcoin is at 80,894, above 80,000 for the first time since May. Equity volatility, meanwhile, is somewhere around 15.5. Hold on to that one. Stock volatility is priced for a quiet week in the same fortnight that carried an economic offensive against Iran, a trade war with Canada, and the largest earnings print of the year. First of 3 places where we part company with the consensus. Everyone says Nvidia's 7 down days are pre-earnings caution, and that story has real support. The stock has fallen after earnings in 6 of the last 8 quarters, 4 of them consecutively, so traders have learned to take chips off the table into the print. The trouble is that story explains a week, and we are looking at 8 months. 12% against 61% is not a positioning wobble. It is a repricing, and the mechanism we think explains it is that Nvidia has changed what it is. It has moved from selling the equipment to financing the people who buy the equipment through a $30 billion equity stake in OpenAI's $110 billion round, $2 billion into CoreWeave, $2 billion into Nebius, and financing platforms built with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR, aimed at mobilizing more than $500 billion for artificial intelligence infrastructure. When the seller of the equipment also funds the buyer, revenue and credit risk stop being separate lines. That is a lower quality dollar, and a lower quality dollar earns a lower multiple even while the revenue itself nearly doubles. Today's focus episode is built entirely on this, including the 4 strongest arguments against it. Second, Bitcoin is above $80,000 for the first time since the middle of May, and the read everywhere is that a new leg of the bull market has started. The level is real. It traded 80,894 after peaking above 81,200 late Monday night. But CoinDesk went and looked at the plumbing underneath that move, and their conclusion is the opposite of the popular one. The surge was driven by short covering, not by new leveraged buying, and futures open interest actually collapsed on the move. $282 million of short positions were liquidated, which was 62% of everything liquidated across crypto that day. So the buying that carried Bitcoin through 80,000 was substantially forced buying, people closing losing bets rather than people opening new ones. That is a meaningfully different thing from conviction, and it matters. Because forced buying exhausts itself by construction, it ends when the shorts are gone. One note on the widely quoted plus 29% in 7 days. That figure varies by venue and by window, so we are not using it. The dollar level is the part every source agrees on. Third, the Treasury has been reported to be considering using its general account, which Secretary Bessent has built up to roughly $950 billion against a $550 to $600 billion target under the previous administration, to help fund an expanded program of buying back its own long-dated bonds. Buyback operations were doubled from $2 billion to at least $4 billion per operation. Markets have read that as a backstop underneath the long end of the bond market and priced accordingly. Two things get lost. The first is that the enlarged operations have not started. They run from the 9th of September through the 4th of November. The second is the disagreement at the top. Stanley Druckenmiller, who is widely described as a mentor to Besant, publicly criticized the plan, arguing that artificially suppressing interest rates is a stopgap. Besant pushed back directly, saying the purchases are not an attempt to lower rates artificially, but routine liquidity management. Those are not two spins on one policy. They are two different descriptions of what the policy is, and only one of them can be right. Until the 9th of September, nobody has evidence either way. Follow the money, and the through line today is that capital is being asked to do two contradictory jobs at once. On rates, the 10-year eased to 4.7%, which is relief, but it is relief inside a year where the long end has repeatedly tested the government's tolerance. On liquidity, the Treasury is preparing to deploy cash from an account it deliberately overfilled, which is a genuinely new instrument. And the argument about whether that is plumbing or intervention is unresolved at the highest level of the Treasury itself. On the dollar and gold, the metal is holding near a 3-month high specifically because the dollar softened, and that is the cleanest read available and the only one we will state. On energy, crude fell into an announcement of expanded secondary sanctions on Iran covering digital assets, gold, aviation, shipping, and technology. When oil falls on a sanctions escalation, the tape is telling you that it reads the escalation as signaling rather than as supply. And on artificial intelligence capital, the flows have become genuinely circular. Nvidia is helping to mobilize more than $500 billion toward infrastructure that will be filled with its own chips, while off-balance sheet obligations across large technology companies are reported to be building toward $3 trillion. That is the part of this cycle that gets studied later. Now the sentiment beat, drawn from market and social sentiment monitoring, and today it is unusually instructive, because two of the three most shared claims in markets do not survive a check. The first is a visa fee. Vice President J.D. Vance said publicly that if an American corporation needs workers, it should hire and train Americans, and that traveled enormously alongside a $100,000 figure. Actual proposed fee is $103,265, and it is worth knowing where that number comes from. Homeland Security identified $8.78 billion of costs to recover, divided by an assumed 85,000 cap subject petitions and rounded to the nearest $5. It is long division. It is also a proposed rule inside a 30-day comment period, not law, and it applies only to lottery-selected petitions, not to cap-exempt filings at universities and research institutions. The second failed claim is that 92% of Americans have delayed or abandoned medical care on cost. That figure traces to a survey of about 1,500 adults commissioned by a company that buys structured settlements. Gallup and West Health, who have tracked this since 2021, put it at about 1 in 3. Health Equity says 36%. The real crisis is large enough without inflation. The third claim, Bitcoin above 80,000, is true on the level and wrong on the interpretation, as covered. Two of the day's three loudest numbers are wrong, and the correction travels at a fraction of the speed of the error. Sectors in play, three of them. Semiconductors are the obvious one. The chip complex led the market lower into tomorrow's print, and the tension there is the widest on the board, because the entire sell side is still positioned bullishly. The consensus rating on Nvidia is buy, and the average price target sits near $309, roughly 49% above where the stock trades, with estimates spanning 250 to 500. Bearish tape, bullish analysts. Somebody is going to be wrong in public. Second, trade and autos. Tariffs on Canadian cars, trucks, automotive parts and steel are set to double to 50%, effective the 1st of January 2027, and Canada has committed to dollar-for-dollar retaliation beginning the 8th of September. That is a slow fuse problem with a dated fuse, which is exactly the kind markets systematically underprice. Third, healthcare economics. Underneath the bad viral statistic there is a real one. Gallup and West Health found 47% of adults are worried they will not be able to afford care next year, the highest reading since they began tracking in 2021. Affordability pressure at that level eventually shows up in utilization, in insurer margins, and in politics. The tell of the day is a single comparison, and it is the cleanest evidence on the board. Nvidia, up about 12% this year. The Philadelphia Semiconductor Index, up about 61% over the same period, with Nvidia as its largest component. If the market doubted artificial intelligence, both of those numbers would be negative. If the market believed in artificial intelligence and in Nvidia equally, they would be close together. Instead, the theme is being bought aggressively, and the leader is being bought reluctantly, and the gap between them has widened all year rather than during one nervous week. That is what a change in perceived revenue quality looks like from the outside, not a collapse in the story. A discount applied specifically to the company that decided to finance it. On the radar, 5 dates that actually matter. Wednesday, the 26th of August, after the close, Nvidia reports. Consensus is around $92 billion of revenue, up roughly 97% year over year, against the company's own May guidance of $91 billion plus, or minus 2%, with options pricing a move of nearly 6%, or about $282 billion of market value. The 8th of September. Canadian retaliatory tariffs begin. The 9th of September, the enlarged Treasury buyback operations actually start and run through the 4th of November, which is the first real test of whether that is plumbing or intervention. The 15th of September, a Senate procedural vote is scheduled on the Clarity Act, the digital asset regulatory framework. And around the 24th of September, the comment period closes on the proposed $103,000 H-1B fee. 4 of those 5 are policy dates rather than data releases, which tells you something about what is actually driving this market. The scorecard, and one new call goes on it today, written so that it can be proven wrong. If the Nvidia repricing is genuinely about revenue quality rather than pre-earnings nerves, then across the next 2 reported quarters, Nvidia's receivables and its investment and equity stake lines should grow faster than its revenue does. That is the accounting fingerprint of a company financing its own demand, and it is visible in the filings rather than in the commentary. If revenue keeps compounding while those lines stay flat, the call is wrong, the nerves explanation wins, and we will say so on this show. 2 quarters, public filings, no interpretation required. That is the standard we want to be held to. So here is the question worth sitting with today. For 3 years, the most profitable idea in markets was to own the company selling the tools rather than the companies using them. That worked because the toolmaker carried no risk from any single customer. What happens to that idea when the toolmaker starts funding the customers? We do not know yet. But the price action has an opinion, and it has held that opinion for 8 months. Tomorrow night we find out whether the revenue line is still enough to override it. Today's Focus episode takes this apart properly, including every reason it might be wrong. All of this is research and education, not investment advice. I'm Earl. This has been the Asymmetric Signal. 1 contrarian read a day. Subscribe.